I've heard several individuals recently state the United States government is bankrupt. By bankrupt, I assume they mean insolvent, as typically a court of law needs to declare an individual or organization bankrupt. Merriam-Webster defines insolvent as unable to pay debts as they fall due in the usual course of business, or having liabilities in excess of a reasonable market value of assets held. Each year, the U.S. Government Accountability Office, the GAO, audits the U.S. government's financial statements. In the audit released last year, the GAO reported the U.S. government had assets of $3 trillion, comprised mostly of student loans receivable and property, plant, and equipment. The U.S. government also had liabilities on the other side of the balance sheet of just under $20 trillion, comprised primarily of $12 trillion of debt owed to the public, that's the national debt, plus $6.5 trillion of federal employee and veteran benefits payable. The U.S. government's net position, defined as assets minus liabilities, is negative $17 trillion. That meets Webster's definition of insolvency, as the U.S. government's liabilities far exceeds its assets. Usually when a business entity is insolvent and suffering losses, its creditors get worried and either move to collect the outstanding debt or refuse to lend the additional funds. Yet households and businesses and foreign governments continue to lend to the U.S. government at very low interest rates despite its insolvency and ongoing losses. Like businesses, when the U.S. government spends more than it receives in tax revenue, it suffers a loss. Only we call those losses deficits. Why doesn't the U.S. government record a profit each year by collecting more revenue than it spends, or at least try to break even? It can't. The U.S. government only controls the spending side of its income statement. How much is it going to spend in a given year? But the revenue side is tied to the savings decisions made by households and businesses. Here's why. The U.S. government raises revenue primarily through income taxes on businesses and households. Most individuals earn income by working, which means their income is actually some company's expenses. So it could be their employer's expense. As the employer pays them, that's their employer's expense, but it's the income of the worker or individuals. Households then pay a portion of their income to the government. They spend some and hopefully save the rest. Businesses earn income by spending less than they receive in revenue. In other words, they earn a profit. Profit is just another name for business savings. Those businesses then pay a portion of that profit to the U.S. government in the form of taxes. So profits are just business savings, since by definition, an entity saves when it spends less than its income. Here's where things get a bit complicated. Businesses earn a profit saved by spending less than their income, but their income comes from businesses and households who buy goods and services from them. But those customers, both households and businesses, are also trying to spend less than their income, because if they don't, they suffer losses and become insolvent. So here are two axioms that we need to keep in mind. Whenever a household or business spends $1, that dollar is someone else's income. That's just how it works. So a household or business spends $1, that's their expense, but that same dollar is someone else's income. The second axiom is the only way households and businesses can save is to spend less than their income. Think about that in your own household. You can only save if you're spending less than your income. Now, there's a conflict there. So if every dollar spent is someone else's income, and the only way to save is to spend less than your income, then it's impossible for businesses and households to collectively save unless some outside entity is spending more than its income, suffering a loss and risking insolvency. And that entity is the U.S. government or other national governments. When businesses collectively try to increase their savings, i.e. boost their profits by spending less, they do so by firing employees and buying less from other businesses, which in turn affects those businesses' income. The result is lower income for both households due to higher unemployment and businesses because they are spending less, creating less income for all businesses. That means federal government tax revenues will be lower, leading to a larger budget deficit. At the end of the day, that excess spending over and above what the federal government collects in taxes flows into the economy, boosting company profits, which means total savings actually increases to the level businesses and households desire. That's the only way it can work. Businesses and households make the decision how much they want to spend and how much they want to save. And the only way they could collectively save together is if the U.S. government runs a budget deficit. And the bottom line is the U.S. government is insolvent because its debt greatly exceeds its asset. And that debt represents decades of budget deficits that are a consequence of businesses and households desiring to save money. And where do businesses and individuals like to invest much of their savings? Well, in U.S. government debt, known as U.S. Treasury notes and bonds. But why do they continue to do so if the federal government is insolvent? Because they believe they will get their principal back with interest. Hey, if you like this video, go ahead and hit the subscribe button below, and you'll be notified next time I upload a video.